You don't need to be rich to retire with $1 million. Honestly, most people think it's some impossible dream reserved for high-income earners or lucky stock pickers. But what if I told you that an ordinary person with an average salary could hit that seven-figure mark? You just need the right plan, a little discipline, and to start in 2026. Let's break down exactly how you can do it, step by step. It's simpler than you think. So, why is $1 million still a realistic and powerful goal, even with inflation? Well, for many people, it represents financial freedom. It's the point where your money starts working harder than you do. It's not about buying a yacht. It's about having the choice to stop working, to travel, to spend more time with family, or pursue passions without worrying about a paycheck. $1 million invested wisely can generate a significant income stream for decades. It's the difference between just surviving in retirement and truly thriving. While the cost of living is rising, the power of compound interest is a timeless force that can help your savings outpace inflation and grow into a substantial nest egg. It's a goal that gives you a clear target and a proven path to follow. Now for the fun part, the math behind hitting $1 million. It all boils down to three key ingredients: how much you invest, your rate of return, and time. This isn't magic. It's the beautiful, predictable power of compound interest. Let's imagine you earn an average annual return of 8% on your investments. If you invest for 30 years, that initial dollar you put in doesn't just earn 8 cents. The next year, it earns interest on the original dollar asterisk, plus asterisk the interest from the year before. Over decades, this effect snowballs and does the heavy lifting for you. In fact, if you invest for 30 years, a huge portion of your final $1 million portfolio will come from growth, not from your own contributions. We're talking potentially hundreds of thousands of dollars just from your money making more money. This is why starting early is so powerful. But even if you're starting a bit later, hitting that million is still very much in reach. Let's look at the specific numbers. Okay, so how much do you actually need to invest each month to reach $1 million? Let's use that 8% average annual return as our benchmark, which is a historically reasonable expectation for a diversified stock market portfolio over the long term. If you start at age 25 and want to retire at 65, you have 40 years. You would only need to invest about $300 a month. That's it. It's $300. But what if you're starting later? Let's say you begin at age 35, giving you 30 years. You'll need to invest around $750 a month. If you start at 45, with 20 years to go, that number jumps to about $1,700 a month. You can see how time is your greatest ally. The sooner you start, the less you have to contribute out of your own pocket, because compounding has more time to work its magic. So, if you're gearing up to start in 2026, figure out your timeline and find the monthly amount that fits. It might mean cutting back on a few things now, but the payoff for your future self is absolutely massive. Let's talk about asset allocation. This sounds complicated, but it's just a fancy term for deciding where to put your money. Think of it like building a meal. You need a mix of proteins, carbs, and vegetables. In investing, your main food groups are stocks and bonds. Stocks are like the protein. They have the highest potential for growth, but also come with more short-term volatility. They represent ownership in companies. Bonds are like the healthy carbs. They're more stable and provide steady, predictable income, but with lower growth potential. They're essentially loans you make to governments or corporations. When you're young and have a long time until retirement, you can afford to take on more risk for higher growth. So your portfolio might be 80% or even 90% in stocks. As you get closer to retirement, you'll want to protect what you've built. So you'll gradually shift more of your money into bonds to reduce risk. This rebalancing act is key to growing your wealth while safeguarding it as you approach your goal. So where should you be doing all this investing? The best tools for the job are tax-advantaged retirement accounts. Let's start with the 401k. If your employer offers one, especially with a matching contribution, this is your number one priority. That match is free money. It's an instant 100% return on your investment. Contribute enough to get the full match before you do anything else. Next up are individual retirement accounts, or IRAs. There are two main types, the traditional IRA and the Roth IRA. With a traditional IRA, you might get a tax deduction on your contributions now, but you'll pay taxes when you withdraw the money in retirement. With a Roth IRA, you contribute with after-tax money, meaning no tax break today, but all of your qualified withdrawals in retirement, including all that glorious growth, are completely tax-free. For many people, especially when you're younger, the Roth IRA is an incredibly powerful tool. Maximizing these accounts should be your core strategy. Let's look at a simple, effective portfolio example. You don't need to be a Wall Street genius to build this. It's for someone with a long time horizon, say 20 to 30 years. A simple 3-fund portfolio is a fantastic strategy. It's low cost, diversified, and easy to manage. Here's how it works. You'd put about 60% of your money into a U.S. total stock market index fund. This gives you a piece of thousands of companies across the entire U.S. economy. Next, you'd put about 20% into an international stock market index fund. This diversifies you beyond the U.S., capturing growth from companies all over the world. Finally, the remaining 20% would go into a U.S. total bond market index fund. This is your stability, your anchor. As you get closer to retirement, you might adjust this to be 30% or 40% in bonds. The beauty of this approach is its simplicity. You set it, contribute to it regularly, and let it do its thing. No need to pick individual stocks or try to time the market. Of course, the road to $1 million has its pitfalls. Let's cover the most common mistakes people make so you can avoid them. The biggest one is trying to time the market. People see the market drop, they panic, and they sell. Then they miss the recovery. Or they see the market soaring, and they pile in at the top. Right before a correction, the data is clear. Trying to time the market is a losing game. The key is time inch the market, not asterisk timing asterisk the market. Another huge mistake is paying high fees. A 1% fee might not sound like much, but over 30 years, it can devour hundreds of thousands of dollars of your returns. Stick to low-cost index funds. Finally, people often get distracted by shiny objects, like the hot new stock or crypto. While it can be fun to play with a small amount of money, your core retirement savings should be in boring, proven, diversified investments. Avoid these mistakes and you're already way ahead of the curve. Secret sauce to all of this isn't a secret at all. It's consistency. Investing isn't a one-time event. It's a habit you build over decades. And the people who succeed are the ones who make a plan and stick with it, month after month, year after year. They automate their contributions, so the money is invested before they even have a chance to spend it. They keep investing when the market is up, and they keep investing when the market is down. This is called dollar cost averaging, and it's your best friend. When the market is down, your fixed monthly contribution buys more shares. When it's up, it buys fewer. Over time, it smooths out the bumps and lowers your average cost. The journey to $1 million is a marathon, not a sprint. It's about showing up consistently for 20, 30, or even 40 years. It's the small, steady deposits that build a mountain of wealth over time. So, let's have a final retirement reality check. Reaching $1 million is an incredible achievement, and it's more possible now than ever for regular people. The plan is simple. Use tax-advantaged accounts like a 401k and a Roth IRA, invest in low-cost, diversified index funds, and most importantly, be consistent for the long haul. Automate your savings, ignore the daily market noise, and let compound interest work its quiet magic. The plan starts in 2026. You have time to prepare, to get your budget in order, and to commit to this journey. Your future self will thank you for the choices you make today. You can do this. Thanks so much for watching. If you found this helpful, hitting that like button really helps the channel out. And for more straightforward guides to building wealth, make sure to subscribe. See you in the next video.